Hello, traders. My name is Rachel Deshelle, Senior Manager of Trading Services and your host for Long Options. Now, this is a intermediate class, where we focus on option buying strategies with the assumption that you are already familiar with the basic concepts of options. If you are not, you are welcome to stay, but you may want to check out our Getting Started with Options, a webcast first. Now, today I am joined in the chat by Cameron May. Please chat in your questions, comments, requests for today's session, and please follow us both on X. I am Rachel-CS. Cameron is Cameron May CS. Please like this video today and subscribe to our Trader Talks Schwab Coaching channel on YouTube. Now, today we're going to get into the 3 considerations when it comes to finding long options trades and setting those up. So we're going to talk through that today. But before we get started, let's cover some of those important disclosures here. So options carry a high level of risk and are not suitable for all investors. The information we're going to cover is for general informational and educational purposes only, should not be considered any type of recommendation or advice. Now we're going to go through the Paper Money software application. There are some differences between paper and live, so keep those in mind as we go through our trades today. Now for our agenda, we're going to start, as we always start with this class, with a market overview. We're going to review our past trades from the weeks prior. Then we're still obviously going to discuss the concept of long options, those 3 elements of price, time, and volatility. And then we're going to place new example trades on the Paper Money platform. So let's hop right in here into Thinkorswim, cover our market overview here. Now today, this is a fun day to analyze some charts here in the markets. We had this rising wedge really taking place in the S&P 500. Now keep in mind, with a rising wedge, you have these 2 converging trend lines of resistance and support. You need 2 touches on one side, 3 on the other side for it to be a wedge. And with a rising wedge, like we saw that big gap down today, that breakthrough of support, which is typically what you see on rising wedge formations here. And we did find a familiar level of support right here at the 50-day moving average, which seems to be a battleground here today. Buyers stepping in, really seeming to hold this level so far. Obviously, the day is not complete yet. Should we get another flush below, if some more news or fears come out, we may see another pullback to the 100-day moving average here, which is going to be our next level of support if that breaks right around 67.45 or so. Now that's still just a little bit more than a 1 percentage point away. It's about 1.3 percentage points away. So it's not going to be a huge move if we do see a flush down to that level, but just a couple levels to kind of keep in mind here. Need to hold the 50-day for the bulls, and we have the 100-day not too far below it, about 90 points below it. Now, one of the averages that seems to be holding up fairly nicely here is the Russell 2000 with small caps. Even with that breakout in yields that we saw over the past couple trading sessions, we are still really holding this recent break of resistance here that we did see in the small caps. We saw a little bit of a doji, a little bit of that pause or possible reversal candle in the Russell 2000 there on the last trading session on Friday, and we're closing that gap today. But if we do kind of flush out further, we may find support right at that old resistance, right around 2,600 or so. One last chart for you guys. I think I brought this last week as well. This is just to kind of showcase a relative strength relationship between the Russell 1000 growth index versus the Russell 1000 value index. And what this essentially shows is it basically takes a ratio between this measure of growth versus this measure of value. And if the line is going up, it means that growth is outperforming value. If the line is going down, it means value is outperforming growth. And we've really seen since really the end of October, beginning of November, we've seen this downtrend in that value outperformance. And we actually see this break of support from those former highs of that relative strength relationship that were touched a few times. We just saw that breakthrough on a weekly basis actually last week or so. So this could give further just kind of reiteration that we are seeing a rotation out of growth into some of those more value oriented pockets of the market here, especially which you'll kind of see from a sector level as well. So wanted to give that chart there. I'm going to share it just in case. I know a few folks have asked for it, so I'm going to share that in the chat if you guys want access to that as well. Now, when it comes to our old trades that we are looking to review, one of them that we actually did close out of today, I actually made the decision to close out today, was Rocket Lab. Now, let's look at the trade that we did have on Rocket Lab. If I go to account statement, we went long 5 contracts of the 20th of March, 2026, 75 strike calls at $18. And I just closed those out a little bit before this class around 23.35. So with about a 30% gain, which is a gain that as a trader, I'm definitely comfortable with taking. So that is why I closed out of that trade today. The initial setup that we saw was this flag pattern here where we had this break of resistance, we had a little bit of a retest, and then a further break, which is where we made that decision to buy that call right on this day here with that candle. Now, if I take that measured move, place it from where we've seen, we obviously met that price objective Friday. It would have been nice if I was in the office Friday and not on vacation to be able to manage that trade. But that is one of the things with options is that you typically need to have time to set aside with options trades to take advantage of some of these moves. If you just set it and forget it, likely it's not going to work out for you unless you have those predefined exit targets really set in place there, but decided to take the gains there. The other trades that we are still in are going to be right here. So we took a couple different trades here, and I'm going to open some of these. So we went long a leap the other week on AEM. We are up on that trade, especially with the move today so far, which we are seeing it making new highs yet again. We're seeing another bullish move in Freeport-McMoRan. We went long 5 contracts of the January 2028 55 strike calls. So that was another leap trade that we did as well. FedEx, this was one of a kind of a shorter term trade. We're getting kind of kicked on that trade today, but our stop is still in place and we're going to stick to our plan there. So we did retrace about halfway from this large candle here, but we do have our stop still set in place there. So we're going to let that one kind of do its thing. And then we did have another leap option in Merck, which we're seeing teeny bit of a movement on that. Merck still seems to be moving a little bit slowly for us here, but it seems to be holding support there, our stop down here as well. So I have a question in the chat. How much are you putting in with each of these trades? So great question. This is what our plan is. So our account size that we were starting with was $200,000. The position sizing that we're working with within our account, we are only going to place a trade or commit funds to a trade that's worth 5% of our account. So the most we're actually going to place into a trade is roughly $10,000. And then our trade risk, which is essentially where we are entering in our trade versus where we plan on exiting, that's going to be about 0.5% to 1% of our account, which equates to roughly $1,000 to $2,000 that we are going to initially risk in the trade. Excuse me. Great question there. You're going to see that as we craft through our trades today as well. So now that we've reviewed our trades, done the market overview, let's talk about something and just kind of get kind of back to basics on some of the concepts that we talk about on a week-to-week basis of just setting up a long options trade, almost going through kind of like a checklist, so to speak, of some of the key considerations when it comes to trading long options. And so the first thing we're going to think when we decide whether to trade a long option in general is, what is my goal? Because if my goal is not speculation, growth, possibly hedging, then we're not going to be looking at long options. We may be looking at other strategies. Like if you're looking for income and things like that, you may look elsewhere when it comes to your strategies here. So with long options, we are looking to be very directional with long calls and long puts, or we may use long puts to hedge. So really the goal is speculation, growth, and hedging, okay? Now, the three considerations that we're going to dive deep into today, and we're going to really go into depth over each of these elements, is direction, volatility, and time. So we're essentially going to kind of go from that top-down approach. We're going to look at what the price of the stock is doing by looking at the chart. We're going to look at valid support and resistance levels. So we're going to see if that stock is in an uptrend, a downtrend, or maybe a sideways moving range there, and then identify those levels of support and resistance. And essentially what we're going to do is we're going to use that information to decide, okay, well, are we going to buy a call or are we going to buy a put based off of that direction of that stock? Another thing we're going to look at with those support and resistance levels is just identifying our strike selection as well. So where we would want to possibly buy a call or buy a put, depending on where the price of the stock really is and where we could see it going and the directional move that we'd essentially like to see on our option in that case. So that's going to kind of be the first thing that we go through today. The second thing you're going to see us go through, we're still going to talk about this on the charts as well, is the concept of volatility. And we know volatility is one of those important factors when it comes to an options price, because with lower levels of volatility, you have typically lower option premiums. With higher levels of volatility, typically the premiums are a little bit more inflated. So when you're buying options, typically we want to look for relatively low levels of implied volatility. We want to look at the market environment and the volatility environment that favors a setup for long options, which is that lower kind of level of implied volatility. The other thing we want to look at as well, because we know leading into big announcements, things like earnings, even economic announcements for the overall market, we will typically see with that uncertainty, we'll see a level of implied volatility rising leading up to that event. So that's going to be one of the things we look for, is to avoid an earnings announcement for the life of our option or anytime soon in the level or in our stock that we are looking to essentially trade. And then the third thing we're going to look at is, based off of the information that we covered when looking at the direction of the stock, maybe any trends that are developing, maybe any patterns that are developing in that particular name, we're going to see how long it's taken for that trend so far, whether it's a short-term trend, intermediate, long-term trend, and whether that's a short-term pattern or a longer-term pattern. That's really going to give us an idea of what the context of the overall trend is, and that's going to help us select our time until expiration, because we want to make sure we avoid time decay and have enough time for that option to kind of react and reach that level that we can kind of forecast by looking at levels of support and resistance or possible patterns setting up here. I do have a question as far as just IV. Do we look at the IV, underlying IV chain, or the VIX, or both? Great question there. So when looking at implied volatility of the overall market, obviously you're going to take the VIX as that kind of factor, because that's a synthetic option of the S&P 500. But that doesn't necessarily tell us whether the stock that we're trading has relatively high or low implied volatility. We're actually going to want to dig under the surface into that individual name that we are trading, since with these examples we won't be trading the index, we're going to be trading options on the underlying stock. We want to know what the implied volatility is of that underlying stock, and we want to know whether that level of implied volatility for that underlying stock is relatively high or low to the normal level of volatility in that underlying stock as well. So we're going to give you a couple different ways that you can look at that. So great question there. Now I'm going to go back into Thinkorswim. We're going to look up a couple examples here. Okay. Excuse me. So we have, we've kind of seen this overall kind of weakness in the tech sector. So the names that we're going to look at today, and I'm going to start with an example of NVIDIA today. This is one of these names that has been in somewhat of a sideways moving trend, okay? So that's the first thing we're doing today. We're assessing what the overall trend has been for NVIDIA. Now, most of the year it was in an uptrend, making higher highs, higher lows. But since then, the intermediate trend has kind of stalled out here and has moved in kind of this sideways pattern. Now, if you're new to reading charts, if you're new to kind of analyzing trends, what a lot of traders may do is add this simple moving average onto your charts to kind of really smooth out the data that you're seeing on the chart, really smooth out the trend. And one easy thing that you can look at to really decipher that trend is look at the slope of these moving averages. I have the 50 period moving average here in white, the 100 period moving average there in orange, and essentially this slope has been very sideways for the past few months here, and even the 50 period moving average is starting to turn and curve down a little bit, especially with this gap down that we've seen. So in this name, since we are in more of a sideways moving type of trend here, and if I am, for instance, long 100 shares of this stock in this name, because I am theoretically, or I guess hypothetically, overall still bullish long-term, since the long-term trend has not essentially changed, I may be still looking for a way to hedge my possible position here in NVIDIA. So this is the first example that I'm going to use is going to be a hedging example using a long put. We're not necessarily going to be super directional, because we can see while this very, very short-term trend has made a lower high and a lower low here for just looking at the past couple weeks, we see the short-term trend is down, but the intermediate term trend is still in kind of this sideways pattern. We see the long-term trend hasn't broken yet. What may give me an indication that the long-term trend is broken is if we do see a breakdown of this level, this horizontal support level, right around 170 or so. So I'm going to write this on the chart, 170. That may give me an indication that, hey, this long-term trend has changed. So that may give me a reason to hedge at a possible $170 level. Now, what does that mean? So with a put option, we have the right to sell our shares at a certain strike price by a certain date. So since I am long 100 shares of NVIDIA, my overall bias is still bullish in the long term, which is why I'm holding the underlying stock, I may be bearish to neutral in the short and intermediate term. So I may want to protect some of my profits and cut out any losses if we should get to the 170 level, since that is where I see this kind of pattern of a clear-cut line in the sand of a zone of support there, okay? So that's kind of what we're looking at there. So that's kind of marking, checking off a couple items on our list as far as direction. So I'm going to bring that back up. What is price doing? Well, it's moving sideways. Where could price go in this sideways moving pattern? It could go to 170. So we're likely going to look at that 170 strike when we move to the option chain, okay? So we're still working our way through that checklist there. I'm going to go back into Thinkorswim because the next step on our list, the second key consideration, is going to be volatility. And we talked a little bit about that, but we'll dive in with that a little bit deeper here. So to see the level of implied volatility, an easy thing I can do is just search IMP and double click on implied volatility to add that over to our lower subgraph here. So I'm going to add implied volatility and look at a couple different factors that we talked about here. So if I look at the chart of implied volatility over the last year for NVIDIA, I can see that where prices, or I guess where implied volatility is right now at the bottom of my screen, I would say that's in the lower third of where we've seen, at least the lower third of where we've seen implied volatility really track over the last year. So I'm going to draw a kind of resistance line here that we're seeing in implied volatility. So majority of the year, we've seen that implied volatility has been above that level of resistance. It hasn't spent too much time under that level of resistance there, okay? So implied volatility is relatively low. We'll give you another metric here in a moment to kind of track that. Another thing we can notice too when we have these little icons on the chart is that we don't have any real upcoming events or earnings announcements in NVIDIA here. We can kind of see that we have some space in the chart coming up the next few months, which is probably that time period that we want to be hedged through, is this next few months here. If we're just kind of looking at time, which we'll talk about a little bit more, but we don't see any earnings announcements here, which is one of our checklist items as well. So when it comes to implied volatility, another thing that you could look at to see, in addition to just plotting it on a chart, if you're more of a visual person, another thing that you could do is move over to the trade tab and go to all products. And this is obviously where we're going to place our options trade, but for right now, we're going to collapse that option chain there. You can see what I did by just clicking on that little arrow, and we're going to expand this to today's option statistics section here, okay? And so what we've essentially done is we've found some numerical kind of values on where implied volatility has been over the past year, in addition to what we just saw in the chart. So the highest level that implied volatility has been over the last year is this 92.8%. The lowest level of implied volatility has roughly been about 32%. Now, where does today's implied volatility fall within that range, or within that percentile of 0 to 100 if we were to rank the current level of implied volatility on that last yearly scale? Well, we'd be in about the 18th percentile. So you can call this the IV rank or the implied volatility percentile, which essentially tells you what percentage of the last year's days have had implied volatility above the current level. So what this tells me, with an implied volatility percentile or IV percentile of 18, that tells me that we're in the lower fifth of all the IV data in the past year. So right now that tells me, as an option buyer, I am going to find relatively cheap options, which for me as an option buyer, we mentioned one of those things that we're looking for is that lower implied volatility environment, especially when you are looking to place a hedge on a stock, for instance, like we are in this scenario. A lot of times when traders are looking to hedge, they are looking for obviously a little bit of a change in trend that tells them that a bigger move could possibly be coming, or just identifying certain levels of support on the chart that they say, hey, below this level, I will feel comfortable selling my stock or just making money in the individual option should I see that drop in my underlying stock position. So this would kind of give us that type of environment where we've already seen a little bit of a break in that short-term trend, yet we still have a relatively low implied volatility environment that would support us buying an option, or what traders would say going long an option in this case would be in that case. So and I see in the chat Chris mentioned IV percentile is actually 37. I would try refreshing your page. If you go if you log out and log back in, it may reflect it a little bit differently here, but the current implied volatility level that I'm seeing on my Thinkorswim is roughly 18% there. Okay, now I have another question mentioning the put to call ratio here. Okay, great question. So the put to call ratio here is interesting because it basically takes the total number of puts traded, divides that by calls traded. Now, you typically have this bullish bias to the market, right? So typically there is more calls traded than puts. So a lot of times traders would say a put call ratio of 65% or 0.65 would kind of be kind of like that normal market that you would see for a normal put to call ratio, or kind of like an average put to call ratio. Anything below that is considered bullish in this name, or considered bullish in general. Anything above 1 would be considered more bearish. Now, traders use the put call ratio in a number of different ways. At extremes, it can be used as a contrarian signal. But a lot of times when you're kind of looking at the trend, that could give you a or kind of like a break in trend, it could give you kind of a signal to what is happening in this overall market, whether this dip is essentially being bought or not. So right now we are having a little bit lower of a put call ratio, which leads us to more of a kind of like bullish bias where we are right now. So we may be seeing folks kind of speculating and buying this dip in NVIDIA here. Okay. So if we go back to the charts here, move back to our checklist after we've looked for volatility, we've seen that it's a low implied volatility environment. We don't have any earnings anytime soon, so it would be a better environment, or an environment that would favor buying options. Now let's look at the third and last key consideration when stepping into long options. Is the trend that we're looking to kind of hedge, is that a short-term trend? Is that an intermediate-term trend? Or is that a long-term trend? And we kind of talked about how we are long 100 shares of stock. So in the long term, we haven't seen that true break in trend. But in the short term and in the intermediate term, there is a little break in the very short-term trend, and we see price kind of finding its way through this intermediate sideways moving trend. So in the intermediate would be what we would be looking to hedge, and that would be that level at 170. If we saw that long-term break of that long-term support around 170, that's kind of the level that we would be looking to kind of take a move on. So let's kind of take that into consideration just when speaking about that intermediate term trend, since that's the one we're really watching here, especially looking at the 50 and the 100-day moving average here. So I'm going to move to the trade tab, go back to all products here, and I'm going to expand our option chain. So if we're just looking at the intermediate term, which we saw over the last few months or so, we kind of saw this 3-month sideways moving trend. And actually, I'll flip back to the chart so you could see that yet again. So we've seen really since kind of this candle here back in November, maybe even a little bit earlier, we have seen all of November, all of December, and most of January just kind of moving in this sideways trend, okay? So that gives us about 3 months there. Now, if that level that we've seen that's been touched multiple times in the last 3 months, if that level breaks, that's going to be kind of what we're most concerned with. So if I'm looking for kind of a 3-month protection here, I may be looking out to the 17th of April here with roughly 87 days left until expiration. Now I'm going to expand or collapse the left-hand sidebar here. And I'm going to scroll down to kind of some levels that we talked about today already. Now, based on the current level of implied volatility, if I look in the upper right-hand corner of this option chain here, I can see that the current level of implied volatility for this option series is roughly 47%. And what that essentially does is it calculates a certain dollar move that we could see in this stock, a dollar move up or down based on the level of implied volatility over the next 87 days. And this shows that we could see that level or that kind of directional move of either $33 up or $33 down. So big possible move in either direction here. Obviously, we do still have a 3-month period here. Excuse me. So we talked about a level that we want to technically hedge being that 170 level. So if we do see a drop below that level, we still want to have the right to sell our shares at 170 if that's what we decide to do. And so we may be looking at the 170 strike, since that was a level of crucial long-term support that we saw on the long-term chart there. Now, another thing when you're hedging as well, rather than being directional, is a lot of times our hedge, you don't necessarily kind of hope to use it, but it is technically your protection there in place, so that if the price of the stock continues to move down, the value of our option will essentially move up in this case. So a lot of times when hedging, you will see kind of traders maybe target a level a little bit out of the money in this case, whereas opposed to if I was more directional on this stock, if I wanted to take more of a conviction in a true downtrend in this stock, I may look for a little bit of intrinsic value, looking a little bit further in the money here. But since we are just looking for this hedge as a little bit of cheap protection here, relatively volatility speaking, and slightly out of the money, so the option premiums will be a little bit cheaper, we mentioned looking at this 170 strike here. Now, a couple things with this strike are delta on this option. So this kind of speaks to the direction of our underlying option. And this essentially says, okay, if we're going to see a $1 move up in the stock, how much should our option theoretically lose? And it's roughly 35 cents. So if this doesn't move down in this direction, we're not going to lose too much on a decay level of the option. It may just kind of slowly decay more as far as time, which is our theta decay here. So this is our time, that value that we will lose with theoretically with each passing day, which we do need to take in consideration as a long option buyer. which is also why we looked a few months out in expiration, because we're not going to see as much time decay as we would see with a nearer term option here. And then another consideration that we kind of already discussed was our volatility, and this is what our Vega sensitivity will really tell us, is per 1% change in implied volatility, how much this option will theoretically move as far as volatility. And I see a couple questions in the chat. So yes, this is a protective put for the stock. So this is what we're doing. We're using this as a hedge. We're using this as a hedging example. We're not speculating. We are just hedging in this sense. Now, since we do have 100 shares of stock, we want to make this a married put in this case. So which means we want to buy one contract of this option. And with this will give us our right to sell our underlying shares that we bought here at a price of 170 should it go lower. Now I'm going to actually show you guys something else as well, because one thing to keep in mind when we are placing a long options trade is that we are essentially risking that entire premium. And so if I'm just buying one contract here, staying well within our position sizing rules, staying even well within our trade risk parameters for the account, which is why I'm not going to put a stop on this one, especially since we're using it as a hedge, not as a directional play. I am risking a little over $1,000 on this trade here. Now, if I right click on this trade and I analyze the trade, that'll take me to the risk profile tool. What do we notice here? What does this risk profile actually look like when we have our long stock? We have our long stock and our long put. So if we have a married put, what does the risk profile actually look like for this stock? Because to me, it looks like a different type of trade that we would be seeing. So pull that in the chat. What type of risk profile this actually looks like for NVIDIA here. I'm going to give you guys just a minute to place that in the chat there. Okay, I see bullish. Any others? What specific trade does this look like? Okay, now I'm seeing some come through. Okay, no risk. No, we definitely still have we still have limited risk in this case. It helps. This trade definitely does limit our downside risk. So we do still have risk, which is essentially the price that we are paying for this option in this case, plus kind of that move on the stock as well. But essentially our risk is going to be a little more than $2,100 in this case for the most that we could lose on this option. Now, a lot of you guys are coming through with that long call as well. So yes, this is a synthetic long call option because we have the long stock here, which is our essential bullish position on NVIDIA. All we are doing here in the short term is just hedging this option. So these two trades, the long-term kind of bullish stance, the short-term bearish stance where we have limited risk, pairs together and looks like the risk profile of a long call option, which essentially a long call option we know has limited downside, has your max loss, the most you can lose, and has uncapped upside potential, which is what you're going to see here with this option as well. So we have unlimited upside potential because the stock price could continue to run up to infinity, but we have capped our downside risk in this case, and that is what that put option does. Now our break even, if we just kind of click on this slice right here, because we are paying 170 for that put option, we are paying for that protection. We will have kind of our break even to the upside of 191.18, which is essentially just taking the current price of NVIDIA plus our put in this trade. So again, break evens calculating the same way as a long call risk profile would in that case. So we're going to move back to the trade tab here. We are going to look to place this trade right now as a limit order good for the day. And we're going to place this in our long options trade here. Again, we're not placing a stop order on this trade. We're not placing a profit target on this trade. The reason why, for the downside, because the most we're risking is what we're placing into the trade, our premium, which is roughly $1,000, still well within the risk parameters of our account. And then the other reason why we're not placing a profit target is because we're using this to hedge. Remember, we do have the right to sell our stock if it goes below that price. We can definitely make a decision when and if that time comes, but essentially that is what we're looking to do. We're going to take that send right there. Now I have a valid question here in the chat actually. What if I only have $20? Okay, so what if you only have $20 but you still want to protect this from a downside move and essentially still hedge this option? Well, that is where traders may consider another strategy called a zero cost collar, which we don't typically talk about too much in this class because the first half of it is a long put option, which again gives us that downside protection if the price of the stock should go below that strike. But essentially what a collar option could do, if you don't have enough cash to outlay for the put, you could essentially sell a call option on the upside, which could be near the same price that you would be paying for that protection on the downside. In this sense, if I sold a call option on the upside of a 190 strike, that would cap up my upside, but it would also allow me to bring in a premium of roughly $11, which would net out to a net credit in this case when looking to protect my options. So in this sense, that's kind of called a collar strategy, a zero cost collar. Keep in mind the downside of that is it is going to cap up your upside if it should move above 190 in that case. And just those kind of call obligations are to the obligation to sell your stock at 190 if it goes above that. So kind of keep that in mind. But great question there on what you could do with a little bit lower cash amount if you still wanted to hedge or protect. So you guys, we covered a ton today. We covered those three key considerations: the direction, volatility, and the time component when it comes to stepping into a strategy with long options. Obviously, the number one question we have to ask ourselves in the beginning is, what is my goal? Do I want growth? Do I want to hedge? And then we can kind of take all of these key considerations into play when it comes to long options. So hopefully this was helpful today. Thank you all for your engagement, questions in the chat. Thank you for joining. Thank you for Cameron May for really helping us out today. And please give us a follow on X. He is Cameron May CS. I'm Rachel-CS. Please like this video if you found it helpful when it comes to that checklist and considerations even when hedging a particular stock position. And please subscribe to us, Trader Talks Schwab Coaching on YouTube. I will see you later, traders. Have a great rest of your day.